out there. So with that, we'll go ahead and get started. Do know that it's a little bit of a tougher market out there, and I'm not trying to bring you down with any of this discussion, but I do think there are some silver linings that are out there, and I'm trying to highlight those as well. But here, when begin this discussion of cotton prices, I think it's always appropriate to begin with a cotton price chart. Here we have prices going back to late 2022. The reason why I'm highlighting that is because I want to highlight some of the changes that have occurred in terms of cotton prices in recent months. And to do that, we need to highlight some of the relative stability we had from late 2022 all the way through up to early 2024. So during much of this time period, we were trading in a cotton a range that was generally between about 75 and 90 cents per pound. Within that range, especially as we got towards the later timing of it, we saw some challenges to both the upper and lower end of that trading range. On the upper side, there were some supply concerns. So when our crop tightened up, as we got closer to harvest last year, we did see prices trade more 85 to 90 cent per pound range. Then the market started paying attention to some of the weakness in demand that unfortunately has been a lingering issue for us. And we tested the lower side of the range as we got into the end of the 23 calendar year and moved into 2024. As we started the 24 calendar year, the market started paying attention to some supply concerns. Of course, we had a smaller crop in the U.S. There was some concerns about exportable supply that briefly pushed prices up over the dollar mark. But since then, those concerns have largely been alleviated. There's still these demand issues we've got hanging over the market, and we're seeing bigger crops come out from several exportable sources, which have pushed prices back below that longer term range. So after a period of relative stability that we had for well over a year, we've had challenges to that range with both some movement outside of the range on the upside and now to the lower side. So when we look at it, particularly when we take a look at some of the increases we had in prices early in 2024, some of that likely had to do with speculator involvement. When you take a look at explanations for the cotton market, I do find, blaming it on speculators or pinning it on speculators to be a little bit of a cop-out because they always move the market. They move the market by trading their positions. They can go long, they can go short, and as they change those positions, that can cause prices to move. But something that we need to keep in mind is that even though they can change their positions, they do that for a reason. And a lot of the reasons that they change their positions for are ones that we can follow along in the market. So here to this chart of our prices, we got a little bit different time frame than I had on my larger chart I showed you before. We're adding our speculator net position. So the positive values are these blue areas above the zero line on the right axis. That is showing you bets that prices would increase, and these negative values are showing their bets that prices would decrease. When we take a look at how they've changed their positions over time, we can identify what they've been looking at. So something they were looking at as we saw them move from this very large net long position to a net short position. This coincided with increases in interest rates. The Fed started increasing interest rates in March of 2022. Pullback in demand probably was a factor contributing to some of the decreases we saw in cotton prices and that big change we had in speculator positions. We did see speculators increase their long position within the U.S. crop number decreased last summer. Since then, we've seen them moved briefly to a net short position. Then they created a big net long position. You take a look at the size of their net long position that they had early in the 24 calendar year. It was about as big as their net long position they had in this very strong period of demand back in early 2022. And then here more recently, there's more concerns about oversupply and these lingering concerns about demand that have switched them back to a net short position or betting that prices could hold at lower levels. So a little bit back and forth. Once again, speculators cause some price movement. When you run the numbers, what really affects how speculators affect prices is their change in their position, not so much the level that they're holding. And I think that's something that's important when we bring in some other context. So here we've got a very long chart of the same data. So we still have our net position held by speculators, and we have our cotton prices. If you take a look at their current net short position, it is actually the most net short that they've been on record using these futures and options data going all the way back to 2008. We take a look at other periods when they were having net short positions, some other really significant events out there in the market, such as COVID. They're more net short than they were during the COVID time period. This other period where we do see a big net short position, that was with the onset of tariff increases during the trade dispute, and current positions are even more net short than they were back then. So speculators have had a big swing in their positions. We talk about swing and speculator positions being a driving factor for changes in prices. And that's how we went from prices that were over $1 very briefly down to levels that have been below 70 cents here recently due to these concerns about not enough exportable supply evolving to concerns about a glut of exportable supply in the market currently. But I talked about, trying to point out some silver linings. One silver lining is here, once again, when we take a look at the price dynamics, how do speculators actually drive movements in prices? It's when they move their positions or change their positions. And since they're already so net short, it seems a little bit unlikely that they would go even deeper net short. So with that, maybe some of the price decreases already in the market, and maybe we've already got our bottom realized. But I want to provide a little bit of context for where we are in the current market, and to do that, once again, we need to talk a little bit about where we've been. And when we look at where we've been, particularly in the preceding crop year, the dominant story was the surge in Chinese imports. So here on this chart, we've got Chinese imports by crop years, and you can see the volume they brought in 23-24 was easily more than double, getting up to almost triple what they imported in 22-23. This buying, an important point with it is that it's associated with the reserve system. The Chinese government was making those purchases. It was not really driven by downstream mill activity, an important distinction there in the current market. What happened in China, there were some concerns about the domestic crop last year. We did see Chinese prices start to move higher. There was some concerns about speculation within the Chinese market, and the Chinese government pushed back against that by conducting some sales from their government reserves that occurred between July and November of last year. So they sold about 4 million bales, and what they brought in terms of their increase in imports, you can see much larger than that. It's about 9 million bales in terms of the difference. So they more than replenished whatever was released. For the market, something that was very important is that this big increase in Chinese imports has to be fed by cotton supplies coming from somewhere. And that cotton that flowed into China last crop year came from essentially everywhere. Take a look at Brazil. They had a huge increase in their exports to China. Of course, they had a large crop last year. We had a small crop last year, but we still had a very important increase in our shipments to China. Australia is moving away from the soft ban that China had on their Australian cotton exports. That's the reason why they had such a large percentage increase in their shipments volumes to China. And then the rest of the world, which would largely include West Africa, also had a very sharp increase in the amount of cotton going to China last crop year. Now, all this matters for prices once you start backing into where that cotton was coming from. U.S. traditionally were the world's largest exporter, and we had the smallest crop last year going back all the way to the 1980s. So there was a lot of concern about tightness in the U.S. supply situation around the start of the calendar year. And that fed into some of the price increases that we experienced in the beginning of the 2024 calendar year. So once again, that crop of just over 12 million bales, it's the smallest that we've had going back in decades, even though it is in the ballpark of where we were back in 13 and 15 when we had some drought situations out there in West Texas going back about a decade ago. But then the market, I think, realized that, there are other sources of supply outside the U.S. So in particular, the Brazilian crop has been getting bigger in recent years. Brazil collected a record cotton crop in the past crop year. A lot of that cotton, is going to be exported. And, there are other sources of supply out there. And that availability of Brazilian supply, I think, was something that the market maybe wasn't paying enough attention to. But it did start to pay attention to more once we got into the spring months and as we got closer to some Brazilian harvesting taking place. We can say that not only due to supply and demand numbers, but also we can take a look at some of the prices. So what I'm showing you here, this is a Brazilian price. It's their middle grade or medium grade, as Kotlik would classify it, that's eligible for inclusion in the A index. And what I did was take the difference between that Brazilian price and the A index. And if you take a look at those values in late February, which is when we did have our New York futures briefly go over the dollar mark, you can see that Brazilian prices were trading actually at a slight premium to the index. But that changed pretty sharply as we got into early March. You can see that Brazilian prices from going from a 1 to 2 cent premium dropped all the way down to a 4 cent discount relative to the A index. And since then, we've seen Brazilian prices essentially be the cheapest prices of all the quotes that are eligible for the A index or global exportable supply since then. So a lot of Brazilian cotton out there that's been weighing on the market, and that's had an impact on our prices here domestically. You take a look at the New York nearby price here, just laying that on top. You can see Brazilian prices broke lower first, and that was something that helped break the futures market lower as well. So concerns about U.S. exportable supply situation due to strength of Chinese import demand being somewhat reversed by this availability of Brazilian supply, and that's showing up in our price dynamics. Something else the market probably needed to pay more attention to, and we did have those very strong prices too, is that there's still some issues with global mill demand. So we talked about a lot of the Chinese buying, a lot of the Chinese imports, a lot of that being driven by Chinese government policy, trying to replenish and then even build their reserve stocks. But that's different than mill demand and downstream demand, which has been in a challenging place for the past couple of years. We can get a better idea about global mill demand by taking a look at export shipments outside of China. So what we've got is a year-over-year change from 22-23 to 23-24 from our major machine-picked exporters, the U.S., Brazil, and Australia. You can take a look at the changes that we have from the U.S. and from Australia. We do see some decreases year over year. You may be thinking some of that's driven by the fact that China was buying up so much, there just wasn't enough left over. But if we do the math and even include that Brazilian increase with their bigger crop, we can see that collectively shipments to the world outside of China were down 10 to 15% year over year. This is a reflective, I think, once again, of some of the weakness in downstream demand, some of the sluggishness that's been out there since interest rates started to increase. So, on top of there being additional Brazilian exportable supply to defeat the argument that there's not enough exports to go around because China's buying everything up, there's also demand weakness out there as well that I think contributed to some of the price decreases we had from early in 2024 to the present. Something else that could be a factor is that those higher prices have coincided when a lot of producers, particularly in the Northern Hemisphere, are making their planting decisions. So here we are, early on in the 24-25 crop year. But if we rewind the clock a little bit, take a look at when those prices peaked. They did peak at the end of February, which is still around that window when prices can be locked in for a discovery period for crop insurance and some other protections here in the U.S., but also some of our other Northern Hemisphere producers may have liked those prices and maybe would have also switched over into cotton. But it is something that shows up in our numbers. So what I'm showing you here is our acreage planted estimates at different periods in time. Gray bars are showing you acres planted in recent crop years. The green bars are showing you the evolution and estimates for plantings for the current 24-25 season. You take a look at the NCC numbers, which were based on prices before we had that run early in 24. We can compare them to where we are currently. We can make the argument probably pretty easily that those increase in prices did bring in a decent amount of additional acreage. And if the market was concerned about supply, this is self-corrective, and then it probably did bring in some more acres than we would have had if prices didn't have their increase. But we can take a look a little bit closer towards what's going on in terms of U.S. production. What I'm showing you here are crop condition ratings. This gray area showing you the range of condition ratings that are good or excellent over the past 15 years. Here's the average over the past 5 years. You can see that there is a general downward trend as the season progresses, with the crop conditions getting a little bit tougher. Similar situations holding for the current crop year. We have seen condition ratings decrease, which is something that we've seen in many of our recent crop years, an exception being back in 2021 when the situation was a little bit better. But the implication, as we're evolving our discussion away from plantings, away from where we've been towards where we're going, this is all feeding into our production outlook. And we have seen our U.S. production numbers decrease over the past couple of months for the 24-25 crop year due to weather conditions getting a little bit more difficult, particularly out there in the important growing region of West Texas. So here we've got our acres planted, acres harvested. An evolution this year is that probably looking at less abandonment, even though we do have some issues with the weather continuing. But in terms of dynamics, the past couple crop years, of course, the dominant theme has been abandonment as being an issue. This crop year, abandonment probably not going to be quite as dominant. We'll still see where the numbers actually end up as we get a little bit further down the road. But what we are seeing is a decrease in yield. So we're harvesting more acres, but the acres that we're harvesting may be on a little bit more difficult land. And that is contributing to our yields expected to be a little bit lower this year. But backing everything in together, we are expected to have an increase in production this year. We are having that increase in planted acres that's going to help. Decrease in abandonment also going to help. We're expected to produce about 2.5 million more bales than we did last year, which is an exceptionally difficult year. Take a look at the volume we're expected to grow this year. It's essentially dead on the average that we've had over the past 4 years, which have been 4 years of, relatively difficult conditions out there, particularly in West Texas. So that's where we are in terms of the crop number. We have seen that crop number decrease from levels of around 17 to 16 million bales in terms of figures that are being released earlier in the spring. It is somewhat notable that, the U.S., traditionally the world's largest exporter, has seen its crop decrease 2.5 million bales, and we haven't seen prices react. But a reason for that is that, we're just one piece of the global puzzle, and there is additional production coming in from other locations around the world. So here you have year-over-year change in production expectations on the left, pie chart showing the distribution on the right. We are expected to have the biggest increase in bale terms, followed closely by Brazil. Then a little bit of a mixed bag when we look at the rest of the world, but globally expected to be producing more cotton this year than last. We take a very quick spin through the wonderful world of cotton. Begin by taking a look at China, which is the world's largest producer. Crop conditions there generally been okay. Forecasts in terms of Chinese production have been moving higher over the past couple of months. China has all those reserve stocks they brought in last year, so Chinese market is looking pretty well supplied as we move into the 24-25 season. India, a number 2 producer, their acreage is down and may actually end up being down relatively significantly. They've also had issues with the weather here over the past couple months. Their crop numbers getting smaller. The big story from India this year will probably be that the government will need to step in. They have guaranteed prices for their producers. Those price guarantees are enforced by government entities actually taking physical possession of that cotton, meaning it's withheld from the market. With prices being lower, a significant proportion of that crop is going to go into government hands this year. A counterpoint to that is that even though it does go into government hands and is withheld from the market, the storage there is not the same as it is in China. So in China, storage and government reserves can last for several years. Usually in India, it's a period of, several months, and they generally try to get rid of that cotton supply before the next crop comes in behind it. So that's a temporary support potentially for the market, but that cotton eventually will come out on the market and can be sold at a loss. In Pakistan, we're also seeing acreage being down this year. They've had some weather issues as well. Pest issues are always something that we need to watch. We need to continue to watch there. But a story evolving from Pakistan is that they probably will need more imports in this current crop year. So seeing some import demand probably potentially developing outside of China. Transitioning over to our exporters, Australia is expected to continue to have a crop that holds at relatively strong levels for them. They backed off where they were in terms of their record production around 21 and 22, but they're still producing at very strong volumes, certainly very much stronger than where they were around 2018 and 2019 when they were experiencing drought and didn't have water to help support irrigation for their production is nearly 100% irrigated. But a big story out there in terms of global production, of course, is Brazil. They've been ramping up their production over the past several years. Just for some context here, I pulled some history. The Brazilian production in 24-25 expected to be more than double the volume of where it was just less than 10 years ago. Of course, the vast majority of their cotton being exported, so that's a competition for us. But the biggest year-over-year increase in production is expected to come from the U.S. We're expected to produce about 2.5 million more bales than last year, so we have more exportable supply as well. And one of the points why I wanted to put all these exporters at the bottom is just to highlight, all these producers, Australia, Brazil, and us, are expected to have a good or strong, better production this year than last year, leading to a record volume of exportable supply. So if you take, at least in terms of these 3 major shippers, if you take the difference between the amount of cotton produced, the amount of cotton spun domestically, and take a look at the leftovers that we have, that's what we have in the chart there of over 30 million bales available for the market and potentially looking for a buyer. And, the question is how difficult is the competition going to be for those import buyers? In the upcoming crop year, we are looking at a pullback in Chinese imports. Of course, they had this very strong import level last year. This year, they're expected to decrease their shipments. They have a lot of domestic cotton available. The crop's looking okay. Imports came in last year. Some of last year's domestic crop also still looking for a buyer. But on top of all that, reserves increased probably by about 4 million bales last year. And if we did see the situation tighten up, those reserves could be sold at the expense of current year imports. So what that means is that, if the market has to look for import demand somewhere, if China's not going to be there, imports from elsewhere are going to be more important. And you take a look at imports for markets outside of China, they tend to be more dependent on downstream demand. So for that reason, what's the situation going on with downstream demand? Here's the year-over-year forecast expected in terms of global mill use numbers from the USDA. Parallel numbers to what we had in terms of production. You've got year-over-year change in blue, pie chart over on the right. Expectations are that will be a general improvement this year, expected to generally result in some mild increases in mill use for our major cotton spinning countries, with the exception of Pakistan, where they have issues with financing and some issues with electricity generation. Turkey expected to have the biggest bump. Turkey, of course, is an important import market for us. They're recovering from their earthquakes, which affected a lot of their spinning regions. And also, Turkey is pretty dependent on Europe, and Europe's moving on from recession that they experienced last year. So that's helping to benefit them. But globally, we take a look at changes that are expected in mill use. USDA is expecting about a 3 million bale bump. It's helpful. Of course, we'd like to see that number be a little bit stronger. There are those that are out there questioning that number, thinking it potentially could be a little bit weaker. We'll just see where the trajectory is in terms of the macroeconomic situation and consumer demand as the crop year unfolds. But some general improvement is expected, even though with that improvement, we're down below some of those peak levels or stronger levels that we have had over the past decade. But one reason why we have seen this pullback, particularly since we've seen a pullback since the 22 crop years, that interest rates have been increasing. Here I've got some numbers that's related to the U.S. situation. This blue line is showing you interest rates the Federal Reserve controls. The gray bars are showing you recessions. You don't need me droning on to talk about how interest rate increases tend to be followed by recessions. 2-point increase caused the dot-com crash. 4-point increase preceded or popped the housing bubble and led to the financial crisis. Interest rates near zero. It's not a normal thing. That was unprecedented, but it has been, a feature of our global or U.S. macroeconomic situation for the past decade or more. We did see periods of returning interest rates higher, had to back off when growth slowed with trade disputes. That recession was driven by COVID, not so much interest rates, but I just want to highlight that where we are recently, we've had a 5 percentage point increase in inflation since March of 22. This is the highest rates we've had going back since the financial crisis, and also the biggest change in interest rates that we've had going back in several generations. So a lot of concern about a recession. In the US, we haven't technically gone into a recession, at least not yet. But retailers and brands, when they're looking at the outlook, when they're placing their orders, they are looking at this chart easily, such as the same one that we've got. And, you can see there are concerns about a significant pullback from the consumer front, and they have been conservative in terms of their order placement because of that. Something else to highlight is that it's not just the US. So here's that same interest rate that I had before, same chart. To it, I'm adding interest rates in Europe, the UK, Canada. Essentially, any market that has a freely traded currency was moving along with the US in terms of their interest rate increases. A couple reasons for that. If they don't, it'll cause disruptions in their exchange rates. Money will leave that country to another. When their currency decreases or depreciates, if that happens, that can cause inflation. And for that reason, it just makes more sense to move along with what the Fed does. And as in the US, we talked about the potential for higher interest rates to lead to recession. We've been holding on. A lot of that due probably to ongoing effects of the stimulus that we had post-COVID. Also, our labor market has been holding up very strong as well. We still have this threat of a looming slowdown or looming recession that's showing up in these GDP forecasts still going out to the 2025. And since we still have that threat hanging over our heads, that's still something I think that's a threat hanging over retailers in terms of potential for inventory accumulation. And that's something that's making them conservative in terms of their order placement. In Europe, the situation has been a little bit different. They actually did go into recession. Inflation was more severe there than it was in the U.S. Stimulus a little bit less generous there than it was in the U.S. as well. So particularly in the second half of 23, there were some really tough economic conditions, particularly in some of the major markets in the Eurozone. But the good news, looking for a silver lining there, is that they're moving beyond that recession. They're expected to have some stronger growth in 24 and expected to have even better growth as we move into 25. And of course, 24 and 25 overlap with our current calendar crop year. Do want to point out, even though things are improving there for Europe and also for the UK, growth rates that are expected, even as we get out into 25, are expected to continue to be well below where they were back in the 5 years leading up to COVID. So things are getting better, but not necessarily in a great place for Europe. Europe, of course, is a major important consumer market associated with downstream demand for cotton. But there are also, other markets with different things going on. Of course, China has been a source of tremendous economic growth in recent years, been a source of tremendous growth in consumer demand for apparel and textiles. In China, the situation has not been as good as was hoped as they came out of COVID. The collapse in the housing market is a huge issue for them. Seen estimates out there that as much as 70% of consumer wealth is tied up in the housing market. And we've seen housing prices there decrease, anywhere from 15 to maybe 20%. So that's a big impact on the household finances situation in China. And if household finances aren't looking good, they're going to be less likely to spend. We are seeing some stimulus come out in China, but nothing really in comparison to what was released in the U.S. and Western markets with COVID. So the outlook for China is a little bit sluggish growth. We're probably not going to see the strength of consumer demand there, or the strength of consumer demand growth like we've seen over the past couple of decades. Japan's got demographic issues, aging population, older populations don't spend as much. That's an issue for them in terms of their clothing demand, but also an issue for them for economic growth. And you can see that their economic growth figures are very low, even in comparison to some of the ones that we're looking at in other Western markets. So not really seeing strength of consumer demand here in Asia either. And as we look around the world, we're not really seeing a strong motor for growth in terms of these GDP numbers. We don't see a motor for growth in GDP. We may don't have a strong motor pulling apparel demand through either. So the question is, where is that demand growth going to come from really to pull the market higher? We're not seeing an obvious answer right now. And this is all fed into something that I've been calling a recession in textiles since we've had these interest rates increase. We've been trying to figure out, when are we going to finally see a turning point? When are we going to move beyond these fears of a downturn and move towards some stability, have that bottom be reached and see some orders start to flow through the market? We're trying to track it as best we can. It's hard to get good data at the manufacturing level. One of the sources that does exist is this industry survey that's conducted by the ITMF, which is a trade group based in Switzerland. Here's numbers I'm showing you from 23. You can see pretty tough. These data only go back to 2021. So you can take a look at the worst situation and recorded, still going back just a couple of years, but still covering some COVID timeframe there as well. The recession in Europe coincided with some of this. You can see order intakes very low as it closed out the 23 calendar year. That continued as we move into 24 with the business situation remaining dire. And then if you take a look at more recent numbers here all the way through August of the current carp year, we're seeing orders start to improve slightly. So maybe some signal of a gentle turnaround potentially occurring in the market. But we take a look at capacity utilization rates, also from their August report. They're saying it's the lowest point that they have on their survey, once again, going back to 21. And then weak demand is still the biggest concern that's out there at the manufacturing level. So we're waiting for this return in order placement to come. The macroeconomic situation hasn't been tremendously helpful with it yet, and we're not seeing manufacturers really notice a sea change in terms of where retailers and brands are placing orders, at least not yet. But, there are some important factors that could be potentially, a silver lining as we look at what may be happening out in the environment. And one of those is this big disconnect that we have in some of the data related to the U.S. So these are some numbers that, Barry's been sharing, that I've been sharing over the past couple of years, and how we had this really important divergence. So in the U.S., which is the world's largest single market for finished textiles and apparel, we have some separation. So this light blue line, this is showing you U.S. apparel spending. Dark blue line is showing U.S. apparel imports. When we take a look at those spending numbers, these are all indexed, so it's showing change relative to 2015. You can see we had a big surge in 2021 with stimulus. Since then, things have been relatively flat. But even though things have been relatively flat, we've seen a collapse in imports. This collapse in imports followed not long after interest rate increases, but it's enough to result in a 30 percentage point difference between the amount of apparel that's coming in and the amount that consumers are supposedly spending, at least in growth terms, relative to where we've been in these index values. So a big disconnect there. Some of it could be inventory adjustments by retailers due to interest rate worries, but there may be some other things going on. And some of the other things that may be going on, of course, is this de minimis threat. I think a lot of you probably are familiar with that, but de minimis refers to a direct-to-consumer sales model where manufacturers are branched in almost directly to consumers. And one of the reasons why this is such a threat is that it does create some more opportunities for profitability among retailers and brands. So if you're a retailer and brand in the US or another Western market, you're traditionally dealing with about a 12-month lead time. And that means that you've got a 12-month period between when you're guessing or making your best judgment about what consumers want relative to when that product shows up and consumers may or may not buy it. But with this just when wanted model of more direct to consumer type shipments, there's less inventory risks, and that can create some more potential for making money. On top of that, it's a way to sidestep a lot of regulations. There are no tariffs that are applied to these de minimis shipments. Also, all the efforts that we have associated with traceability and forced labor go right out the window. Also traceability for sustainability. There's no ability to track that either. But what I want to show you here is just some of the impacts that this can have on cotton share. This is for the U.S. These are U.S. tariff rates shown on the right. You may or may not be aware that cotton has a tariff advantage, but generally cotton tariff rates are about half of what they are for man-made produced apparel. And of course, when we go to the de minimis route and there are no tariffs, that tariff advantage goes away. We can take a look at cotton share for traditional imports coming in through containers where these tariffs are applied. For knit shirts and woven bottoms, which are two of our biggest category buckets, cotton share doing pretty good. But then we also can take a look at some web scrape data. This is a project we've been doing internally at Cotton Incorporated to track what's going on retailers like Shein, and you can see that cotton share dramatically lower there. So obviously a threat, obviously a source of concern. It's something we've been paying attention to. It displaces cotton demand with cheap polyester for producers. There's a price effect there from lower demand. And then on top of that, of course, there's no funding that goes into the program because there are no assessments that are collected on imports through de minimis either. So effects on cotton share, effects on demand, and also effects on our ability to help fight to maintain cotton share as well. But here just to show you cotton share of traditional imports. So looking for some silver linings over the longer term, there was some pullback due to the price spike we had in 2010, 2011, but more recently, particularly as we come out of COVID, as the dust has settled, share has stabilized and even potentially migrated a little bit higher here in some of our more recent months. So de minimis threat is, of course, something we want to pay attention to because it's not included in these share numbers that are associated with traditional imports. So dealing with the de minimis threat, of course, is a priority due to the fact that, it is a challenge to the program, is a challenge to cotton demand on several fronts. Fortunately, there has been some movement in terms of the politics on de minimis. There's been a bill introduced in the House in the spring. There's a bill introduced in the Senate this summer. And then just at the end of last week, there was a White House administrative action that was announced. There's been called out by New York Times. It has been getting some press out there and getting some coverage with the administration looking to clamp down on de minimis shipments, looking in particular to clamp down on shipments coming from China or in textiles from China, which is where a lot of this polyester product has been coming from under the de minimis umbrella. But, once again, it's really important. If you take a look at this gap we're talking about, taking away from index terms or percentage terms, putting it back into bale terms. If we were to close that gap, and assuming all of this was driven by de minimis and not leaving any room for inventory, that would be about a 3 to 4 million bale gap that we need to close. And that's meaningful, particularly when we go back into our global cotton consumption numbers. So if we're at 116 million bales right now, if we could add another 3 to 4 million bales to that, that does change our demand outlook relatively significantly. And this is just for the US, so if we also include Europe or some other consumer markets that are also dealing with the de minimis issue, that could be something that also could support cotton consumption as well if the de minimis threat is dealt with and if we can transform that into cotton consumption relative to man consumption. But to bring things back to the fiber world, we are looking at a marginal surplus in terms of current USDA numbers in the current crop year. This is would be the third year of essentially in a row of a slight surplus of consumption relative to mill use to some building stocks. A lot of cotton supply out there. But in terms of what's really important and what's really been driving price dynamics is not just the global supply demand situation. It's the amount of exportable supply relative to import supply. And we really have seen just that story do a 180 relative to where we were back in February and March of this year. Instead of there being concern about the exportable supply, we're looking at a competition for import demand. And that, of course, has been something that's been weighing on the market. But I do think, that we are looking at a recovery in downstream demand. We don't know how strong it's going to be, and we don't know exactly when it's going to take place. But, this week we probably are looking at the Federal Reserve decreasing interest rates. We don't know exactly how much. But, even though rates can be expected to stay at higher levels than they were pre-inflation, they're probably not going to go all the way down to rate levels that could be considered stimulative. There's still concern about inflation from central banks. But nonetheless, a change of direction, I think, could be something that could help reduce that fear of a looming recession or a looming downturn that has been hanging over retailers and brands for the past couple of years. And that's something that could eventually help motivate some orders and get some demand pushed through the supply chain. And if we can just get that definitive bottom established in a global macro economy, I think that is something that would help confidence once again for retailers and brands placing orders. And I would say even at a more micro level, taking a look at the world's spinning mills, the series of price decreases for them is just a series of loss opportunities to lose money. So, mills hold inventory. If prices for that inventory decrease, that's money losing opportunity for them. But if we can get a definitive bottom in place, which is something we haven't had really post-COVID, things can improve from there. So if we do get prices bottoming out right now and do see some gentle price increases, that's something that can help improve profitability at the spinning level, and then also even further downstream as other participants also can make money on their inventory as well. So I think bottom is probably close there for the macro economy. Bottom should also be pretty close in terms of fiber prices. And as we move on from there, we get some profitability brought back into the market, which should be helpful for demand. So with that, you guys have heard me talk plenty. I hope I have some opportunity to hear you guys talk a little bit and hear some questions that may be out there.